Hi everyone, my name is Anand and I'm back with another episode in this series on mutual fund investments. A lot of you who have just entered the world of investing, or even those who are pro investors, would agree that over the last few years, mutual funds have become the buzzword in the investment circles. And some of you may be wondering why. In this episode, I will try and explain some of the reasons why mutual funds have become one of the most popular investment vehicle over the last few years. So let's get this started. It wasn't a very long time ago that mutual funds were considered an investment vehicle only for the sophisticated investors, mainly the institutional ones. But over the last decade, we witnessed a complete change in the investment scenario in India, and it will not be wrong to say that the democratization of mutual funds were a major catalyst for this change. Being a chartered accountant and an investment enthusiast, I love numbers and stats. And so here are some interesting ones for you to showcase the growing popularity of mutual fund investing in India. Between March 2016 and March 2026, the overall size of the Indian mutual fund industry grew from 12.3 trillion to about 73.7 trillion. Now, this is about six-fold increase in the asset under management with the Indian mutual fund industry. Here is a snapshot for you showing the YOY growth in the AUM collated from AMFI and other sources. Moving on to the total number of folios or unique investor accounts. While the total folios as of 2021 were approximately 10 crores, this number jumped more than 2.5 times to about 27.39 crores by March 2026. Now, these are not just statistics. These shows a fundamental shift in the Indian investment scenario and how mutual funds have become a household name. But what triggered this phenomenal growth? This cannot be attributed to one single reason. Rather, this is a result of a combination of various factors. Let me take you through some of the important ones. First, the SIP revolution. In my view, this was one of the biggest trigger which made mutual fund a household name in India. Before 2016, most mutual fund investment was lump sum and largely institutional. The democratization of SIPs or systematic investment plans changed everything. SIP did several things simultaneously. First, it made investing accessible starting at even rupees 500 to 1000 per month, and in some cases even at rupees 100 per month. It changed the perception about stock market in general and specifically about investing and wealth generation. It also helped convince people that financial goals are achievable without being a stock market expert. And from the mutual fund industry's perspective, it created automatic recurring inflows which turned the retail savers into long-term investors. And lastly, it built a domestic institutional buffer against the volatility caused by the movement of FIIs and FDIs. The result, monthly SIP inflows went from under 4,000 crores in 2014 to nearly 30,000 crores by late 2025. This wasn't just volume, it was a behavioral transformation. Second, the digitalization and the fintech effect. The last decade can easily be termed as the sunshine decade for India's fintech sector. The convergence of Aadhaar, mobile, UPI and eKYC made opening a mutual fund account as easy as ordering food online. By March 2024, 90% of all mutual fund purchases were through digital channels. This is a structural, irreversible shift. A combination of ease of access and digital safety was just the gunpowder needed to blaze the SIP fire. Moving on, SEBI's regulatory reforms. SEBI's role as a regulator cannot be praised enough. SEBI has been continuously seen to introduce reforms aimed at making mutual fund investing as simple as possible, as accessible as possible for the common retail investor. Be it the circular release in 2017 or the latest 2026 circular, SEBI has been focusing to reduce scheme clutter, standardize fund categories, and improve transparency. This built investor trust, made comparisons easier, and reduced mis-selling in the market. Fourth, equity bull market. The equity bull market, combined with falling returns from the traditional instruments like FDs, proved to be a pivotal factor fueling mutual fund investments. Nifty 50 went from 7,600 in March 20 during the time of COVID first wave to 22,500 by March 2024, registering nearly a 3x move. This had a dual effect. It grew the existing AUM through mark-to-market gains, and it attracted a wave of new investors chasing higher returns. Compared to this, the repo rate went down from 8% in 2014 to 4% by 2020, resulting in persistently modest FD returns even post-pandemic, which eroded the appeal of bank deposits in a lot of retail investors. Last, the mutual fund Sahi Hai phenomena. AMFI, the industry body of all mutual fund companies, brilliantly picked up this evolving and growing needs of common Indian investor and launched its landmark investor awareness campaign, Mutual Fund Sahi Hai, in March 2017. Arguably, this is the most successful financial literacy campaign in India's history, running across televisions, radios, digital channels in multiple regional languages. This just demystified mutual funds for the average Indian household and created a cultural shift where mutual funds became a dinner table conversation. Post-COVID, retail investor boom, demographic dividend, rising disposable incomes and growing women investor participations are some other notable factors which also contributed towards this massive growth. To conclude, Indian mutual fund investing landscape has witnessed a phenomenal growth, but I still feel it is just a start. We are still at about 5 crore unique investors only, while the potential is huge considering India's growing disposable income and increasing requirement for innovative investment products.